Hey everybody, my name's Allison Ostrander and I am the Director of Risk Tolerance here at Simpler Trading. And in this video, we are going to talk about risk management. So let's dive into it. Risk first, profit second, right? Let's just start off with this phrase by itself. In trading, it should always be focused first on your risk, right? It's easy as a trader to get sucked into the idea of solely looking at profits, at your profit potential. But a lot of the times when traders focus too much on the profit side, they lose sight of risk. And when they do that, it's much easier to fall into what I like to call the dark side of trading, which of course leads you into the possibility of blowing out your account. And obviously, that's not something we want, right? We worked hard for the money that we put into our trading account. And so we want to try and make sure we preserve it and see our account grow rather than turn into the red and get depleted. And so, a great way to start off on the right side of the tracks is by focusing first on risk and then evaluating the profit second. So, how do traders control risk? Well, they do it by risk management, right? So, let's talk about that. So, first, of course, how can risk be viewed, right? Risk can be evaluated for your overall account balance, and risk can also be evaluated by each individual trade you hold, right? How much of your total account are you putting out there capital wise to risk in order to grow it? And of course, how much risk are you putting into each individual trade you hold in order to grow your account as well? So, why is understanding risk important? Well, it is easy for new traders to get excited about profits they are taking and to lose sight of how much they're actually investing when they're doing that. And so, oftentimes, when they lose sight of how much they're investing, they start investing too much capital. And when you invest too much capital, if you ever get dinged once on a loser, right, it's a lot easier to wipe out your account. So if you don't have a good grasp on risk when trading, you have a greater chance of wiping out your whole account, right? And that's not what we want to have happen. We don't want to blow out our accounts. So understanding risk, I think, is one of the main keys to staying successful in your trading. So, how can we control risk? Well, there are a few different ways, right? We can control risk by position sizing. Never risk more than you're willing to lose. I am a big believer, a firm believer of position sizing. Usually, anytime I put on a trade, I go into the trade with the idea that I might lose 100% of the capital. And so when I view each trade in that way, right, even if that seems like a little pessimistic way to view it, what it does is it really helps me stay within my risk tolerance for position sizing. And it helps keep me from blowing out my account, right? From over risking too much of the total account value, as well as over risking too much in one trade idea. Another way we can control risk is through our entry points, right? By controlling your entry point, not necessarily chasing the trade, your distance from your entry to your stop loss is smaller, right? And this comes to more on the technical side of things when you're looking at your charts and stuff when putting on a trade. The idea is if something's really taking off and running to the upside or the downside, right? Depending on if you're bullish or bearish, you don't want something that's already had a strong move necessarily to jump into. And it feels like you're chasing, right? It's almost like a case of FOMO where you kind of missed out on the start of the move and therefore you feel the need to chase it in order to participate yourself because you have a fear of missing out what might be left. Well, a lot of the times when traders chase a trade, it usually doesn't work out necessarily in their favor, right? So by keeping a discipline of what your entry points are, depending on the strategy that you're trading, if you have your entry point set up for your trading strategy at a good spot and level to where you're not chasing the trade, it means that you have a smaller distance to your stop loss. So that way, if the trade starts to go against you, there's a better probability that you're able to protect capital on that trade idea versus if you chased it and then had to watch it drop all the way back to your initial entry point into where your stop loss was. Well, that of course can make a bigger ding to your account. And then, of course, another way we control risk is through our methodology, right? Through proper planning and follow through of a high probability plan, right? So we want to make sure, of course, that the strategies that we're using match, of course, the market environment that we're in, and that we have a proper trading plan in place when putting out the trade idea. We don't just want to throw out a trade strategy and hope that it sticks to the wall, right? That's not or usually a good plan to have when trading, and it once again oftentimes can lead to losses if you don't really have a good grasp of what you're doing. So understanding the method of the strategy that you're trying to trade, understanding your entry point, of course, as a part of that, having proper planning, and then of course using trades that have a good probability of working out, right? That are successful and have been successful in that market environment in the past. So, risk, once again, what can risk mean? Well, it can be the capital per position, right? This is defined as the dollar or the percentage of the amount risk per the underlying. So, what does that mean? Well, once again, it's how much of your dollar amount or the percentage amount that is risked in the overall account value. What is strategy selected, right? There are definitely varying option strategies that offer different levels of risk. Some strategies are more riskier than others. For example, an uncovered put, right? What is sometimes referred to as a naked put can be a very risky strategy if the underlying price starts to move against you. You have the possibility of getting assigned shares when that happens. So if you don't have an account that is large enough to hold those shares, that can be a very risky strategy to have selected versus doing something like a put credit spread, right? Something that is definitely limited on the capital risk that you're putting out there. It is a defined capital risk. And so that might be a strategy that has a smaller level of risk compared to a naked put, even though the two strategies work very similar to one another. The overall capital risk, right? Even if you control your risk per position, it must be controlled overall in case of major volatility or an overall event. So, once again, how much capital risk are you actually paying to put on for this trade idea? And going about it, like I said, what I like to do at least is going about it in a way where I am okay losing 100% of that capital. When I go into a new trade idea with that thought in mind, it helps keep my overall capital risk in line for the trade idea. So that way, if there is a major volatility move, if there's a major event that occurs, like a flash crash, or something outside of the market happens that affects it, then I already know that I'm okay with the capital risk out there because I went into the initial trade idea that I might possibly lose 100%. If you over risk the overall capital amount that you're putting in for a new trade idea, and then one of those types of events happen, right, and it goes against you, then you have a lot more that you could potentially be willing to lose. So always be mindful of that, guys. So, one of the questions I get asked a lot by other traders is how much of my account should I risk? And what seems like such a simple question can, of course, vary greatly from who you're talking to and what their own personal risk tolerance is. And so, it's always a good idea to kind of figure this out for yourself. And there are a few different ways, of course, a trader can view how much to set aside per trade in their account. So let's take the time now to go over some of the different methods that traders like to use when they're, asking me that question of how much should my account go into this trade idea. Many traders here at Simpler, and of course outside Simplers, like to divvy up their risk per trade based off an overall percent of their account value. So, for example, a trader may deem that they want to risk between 3 to 5% for each trade idea that they find, right? So they have an overall account value of, let's say, 5,000. If they're willing to risk 3 to 5% for each trade idea, that means they're risking about 150 to 250 per trade of a $5,000 account. Now, if you're in a much larger account, let's say a 7-figure account, then you might not be risking 3 to 5% per trade. You might be risking 1% per trade, right? Or if you're in a smaller account that is, full cash, but you want to be aggressive on how you grow it, you might actually risk 10% per trade idea, right? It all, once again, kind of stems back to the idea of understanding if you put that capital out there, are you okay losing 100% of it? Right? As well as what kind of your game plan is for the account itself, right? Is this your retirement account where you want to stay mostly in cash and have that nest egg available to you? Or is it more of a smaller account that you want to be more aggressive on growing? And therefore, you might choose a larger percentage of the account to trade. Either way, there's no right answer. It all, once again, goes back to what is the risk tolerance for you to kind of keep you as unemotional as possible when going through your trading journey. If a trader thinks a trade is a stellar setup, this means they may bump up their risk tolerance for a new trade idea to 10% of their account value. So, once again, for a $5,000 account, this would be a $500 risk. So, if you see a setup for a trade strategy that's working in the current market environment, and it is like the A plus of setups, right? You know, this would get 100 in a class test. Then you might decide to bump up that risk tolerance a little bit to see if it works out. Now, once again, I wouldn't overload anything myself personally, but there are times when a setup looks really good that you might put a little bit more out there to risk to try and take advantage of that stellar setup popping up on your charts. Another way that traders like to trade their accounts, and this is the way I lean towards it personally, is the dollar amount of the account. So, for example, a trader might have a $5,000 account. And so every time they put on a trade idea, they never want to risk more than $300 per trade, right? It's just a simple idea of here's the dollar amount I'm always willing to risk per new trade, and I'm never planning to exceed that amount. And this means that as long as they can find an option strategy that fits within their risk tolerance and does not exceed it, meaning they find an option strategy that's within the $300 per trade idea and doesn't go past it, then they're willing to put on that trade idea to match the chart entry. So like I said, some people like to go from the percentage of their account and look at it that way, where other traders might look at the pure dollar amount and go off their risk accordingly. And like I said, this is personally the way I like to trade my account. Whenever I jump into a trade, I take it based on the total capital amount I am okay losing 100% on, which, like I mentioned earlier, isn't necessarily the most optimistic way of looking at it. But I find it to be the best way to look at it because, once again, if I go into the trade knowing that I'm willing to lose 100% on it, it one helps me keep within my risk tolerance. I know I'm never over investing in a trade idea. And two, it helps keep me unemotional, right? Sometimes when traders over invest in a trade idea, and let's say it starts to go in their favor a little bit, sometimes they take it off too soon, right? They don't take advantage of the full move to lock in that profit. Or vice versa, if they jump into a larger capital amount than they're comfortable with and the trade starts to go against them just slightly, right? To where the chart still looks good, but the trade itself is in the red a little bit. Sometimes they cut the trade too soon to where it would have worked out, but their emotions played with them and getting out of the trade because they were too concerned about how much capital that they had out there to risk. So by staying within the thought process of I'm okay losing 100% on this trade, to me, it really helps keep me within the risk tolerance and outside of that dark side of trading. And once again, this does not mean that I will blindly trade $300 into a full loss, right? If it's going against me and the chart technicals cancel out, then I'm still out of the trade. I'm still, putting on my stop and protecting capital. But it does mean if it goes against me, I will not be emotional about losing that money that I have out there, right? So if it's a sudden volatile movement that starts to cancel out the trade idea and maybe there's no value left on it by the time I can take action, then I'm not going to be emotional or too upset about having to take that loss. Losing 100% of your capital, right? I personally think, once again, this is one of the best ways to keep the dark side out of trading, is to go into each trade with the thought process that you can lose 100% of your capital. I know this may seem counterintuitive, but it is a great way to risk an amount at a level that you are comfortable with, right? So if you go with a $5,000 account, for example, and you put on a trade idea for 2,500, well, that's half of your account value. And that might cause you to get really emotional about having to sit through the trade to where you might take action that normally you wouldn't have if you had only gone in with a $250 risk tolerance, right? So just be mindful of that whenever you're placing your trades and thinking about it that way. And then also, of course, let's talk about stops. Sometimes traders will go into trades with a larger amount of capital in play, but will use stops to help stay within their risk tolerance. Certainly, futures traders are very familiar with stops, right? They need stops in order to stay within their risk tolerance, certainly. So, stops are another helpful way that if you kind of want to put it a little bit more capital out there, but at the same time, not necessarily risk the full amount, then you have a stop in place to where if the market goes against you, or if that time value, right, that we talked about in one of our past videos, that theta decay starts to work against you, that you can get stopped out and still protect a good chunk of the money that you technically had out there at risk. So thank you so much for joining me for this video. As always, may the trade be with you, my fellow Jedis. I hope this gave you a better understanding around risk, and I look forward to talking to you next time. Bye.